Now. Okay, great. Good afternoon, everyone, and welcome to the ACEC Research Institute's Future of Engineering Roundtable Series and today's session, The State of the Engineering Economy, Q4 2024. Before we get started, I have a few housekeeping announcements. For the easiest view, move your mouse to the top of your screen and select Gallery View. This will allow you to see all panelists. Your microphone was muted upon entry, but if you wish to ask a question or offer a comment, please feel free to type it into the Q&A box at the bottom of your screen. We will do our best to answer as many questions as time permits. This event is open to the media, and the press is invited to participate, as with our other attendees, by asking a question through the Q&A box. We are recording today's event for future viewing. If you require any technical assistance, please feel free to send a message to ACEC Research Institute privately through the chat box, and I will be happy to assist you. Now, allow me to introduce the Executive Director of the ACEC Research Institute, Daphne Bryant, who would like to say a few words. Daphne?
Thank you, Carrie. Good afternoon, everyone, or good morning if you're on the West Coast. Thank you so much for joining us. We have a lot to cover today, a lot to share with you on what's happening in the economy, in the industry, and even within your own firm's finances. So we're going to get started. I do want to give a shout out to any veterans that we have on the call. Happy belated Veterans Day to you. Thank you so much for your service. I hope you had some time off yesterday to enjoy that. We are going to go ahead and get started. I have with me today Joe Bates, who is our Senior Research Consultant at the ACEC Research Institute and author of the Engineering Business Sentiment Study, and also Thomas Grogan, who heads up our economics and private markets at ACEC, who has a lot of great information to share as well. So I am going to go ahead and turn it over to you, Joe, so that we can get started. I know you guys have a lot of great stuff to share with us today.
Great. Thanks, Daphne. And I'm always glad to see you, Thomas. Welcome.
Yeah, happy to be here.
Good. As Daphne said, hope some of you had a holiday yesterday. Some of you I know had to work as well. So we're either starting the week or getting the week going here. We're going to go through three of the areas that we always go through today. How is the general U.S. economy doing? How is the industry doing? And then what does the future look like this quarter? And as Carrie mentioned, if you'd like to ask questions, please feel free to do so. We might have time at the end as well to address questions, but if you have one while we're going through our presentation, feel free to put it in the chat and we'll answer them as best we can. All right, so here is our first look at how the economy is doing today. Actually, things are going really, really well. We got our third quarter reading in at the end of October for GDP, came in at 2.8%, which is very, very solid. We also have our final numbers for Q2 of 2024, which was 3%. These are annualized percentage increases. So things are going very, very well. We had a slightly softer first quarter, but you can see, of course, fourth quarter last year and third quarter last year were also very strong. So that was just a slightly weaker reading there. Everything's looking really good. The update to the Q3 GDP will come at the end of November. So keep a lookout and see if that's revised up or down, or if it stays steady. Lately, in this last year, things have been pretty steady in terms of these revisions, only maybe adjusting by a 0.1 percentage point. So I think we're probably pretty solid on the number, but again, always keep a lookout for that. When it comes to job growth, we have seen the job growth moderate just a bit. For those of you who have seen this slide before, you'll notice I've changed it up just a little bit. I'm showing now the total new jobs created in each month. And we usually will get revisions for the last 2 or 3 months, when the current month is updated. What I really want you to look at is sort of the last couple months of last year and the first few months of this year. We were seeing job growth each month in the 200 to 300,000 range. Starting in April, we saw that soften a bit, and we're continuing to see averages that are a bit lower than they had been, and that's good news. We're actually wanting to see that. It shows that the interest rate hikes that the Federal Reserve had put in place are finally starting to work their way through the economy, but job growth is still quite solid, even though it has moderated a bit. And of course, in October, if you were listening to the news, you may have heard that the US economy only created 12,000 jobs in October. However, that was also a reflection of the hurricanes that hit the Gulf Coast, as well as the strikes that were ongoing at Boeing and a few other places. So that number is a bit of aberration. Everything I've heard is that that number probably was, more like 112,000, but those temporary worker stoppages, if you will, were about 100,000 jobs or so. So what I've heard and what I've heard other economists say is that that's an aberration, and we really shouldn't worry too much about the October number. And really, we're more interested in seeing what happens with the November data come the first week of December. But you'll also see that the unemployment rate has gone up modestly, which again is a good thing. So these are all things that have been intended to help slow the economy just a little bit, because we are trying to get inflation under control. And on this next slide, I know the numbers are really tiny unless you have a huge screen that you're looking at, but we like to look here at the professional and related occupations and what the unemployment rate is in that particular sector of the economy, because that's where the engineering and design services, that's where we all fit. So you'll see that the unemployment rate is 2.3% in October. Compared to last year, it was 2.1%. We've seen this number go anywhere between 2 and 3-ish percentage points. So it's always been much lower than the US unemployment rate. So that just points to continued tightness within the labor market, within our industry, as well as others in the professional services. So GDP is very strong. Jobs have moderated just a little bit, which is good. One of the other data points I like to share is the labor force participation rate, and we're still seeing it kind of going sideways now, or 62.6%. This is the percentage of all adult workers who are actually participating in the labor force. So it's lower than what it was before the pandemic, and that just has continued. So this adds to the shortage of labor. When you talk about a 0.7 percentage point below where we were before the pandemic, that equates to roughly 1 million to 1.5 million jobs less than what we would like to see. Now, we've grown the economy, we've grown the number of jobs, of course, during this period, but part of the shortage is reflected in this lower than what we would like to see labor force participation rate. One of the things that we're also monitoring is consumer spending, because something, Thomas, I know you have talked about recently is that the excess savings that folks built up immediately after the pandemic because of various stimulus payments, we pretty much spent through that. And we also have started to, now dig into other savings. We've spent as a whole economy more than what we saved during those post-pandemic years. I was watching an economic presentation last Friday, and it was very nicely shown on a wonderful graph that I don't have in front of me now, but it really started to make me question, okay, how much longer can the consumer keep propping up the economy, because 2/3 of the economy is consumer spending. But we're seeing very solid consumer spending growth numbers here month over month. These are monthly numbers. And the Federal Reserve looks at what's called the PCE price index. That's actually their preferred inflation gauge. So when we look at the September reading, it was 2.1%, and that was after a 2.3% in August and a 2.5% in July. So finally, the last couple of months, we've seen that inflation rate come down to right about 2%, which is where the Federal Reserve wants to see it. And that is why, of course, they have started cutting interest rates. And tomorrow we'll see if they follow through with another interest rate cut. Thomas, I'm curious, what's your view on that? Do you think they're going to go with their 0.25 basis points or 25 basis point cut, or are they going to hold off?
I unfortunately really think it's a coin flip. I can see both sides as to why they would or would not, but based on some of these data indicators like PCE, those are pretty favorable for having a rate cut. At the same time, I know employment costs continue to rise or stay elevated, right? Which, to your point, people maybe have spent their savings, but if they're making earning more money, then that's allowing them to spend more. So I really think it's 50-50.
Yeah, I think it's a really interesting point right now. 2 months ago when we were still looking at the July numbers and inflation was at 2.5%, I was a little bit skeptical, but now those numbers really came down in the last couple months. So I think because they signaled that they were going to probably cut rates, I think they probably will. I'm not sure they should. I think there's a lot of concern that if they cut rates too quickly, that there still are inflationary pressures within the economy. As you noted, the wage price inflation, and that's something I think is a very big concern. So we'll see tomorrow morning, tomorrow afternoon, what happens. I think they announce it at 2 o'clock Eastern time tomorrow. Now, speaking of the consumer, I've added a couple charts that I have not had in the past because I am really starting to look at what's happening with the consumer. If we don't have any external shocks to the system, it really is up to the consumer as to what happens with the economy, if we are going to go into a recession or not. And so the chart on the left, I think that one, to me, it's a little scary. It's a little bit alarming. That's total debt among households. And you can see that total debt is now close to $18 trillion when you add household debt or housing debt. That's mortgages, for instance. You add that to non-housing debt, which would be credit cards and auto loans and home equity line of credits, things of that nature. And you see that we're well past the top of where we were during the last recession, the big recession in 2008, 2009. So that would have me be a little bit concerned. But on the right-hand side, I pulled the chart from the Federal Reserve, which shows the percentage of debt that households have as a percentage of their disposable personal income. And this one is much more less concerning. It's much more, I think, good news for the economy that you see from, after the last recession when people worked out their debt in 2012, 2013, we came down to around 11.7% of household income was going to service their debt payments. That fell dramatically after the pandemic recession and then came back up quite quickly, but we're below that 11.7% average. We're at about 11.5% as of the last reading. So the right-hand chart would make me think, Thomas, the consumer still has some spending left in them. And as you said, household incomes are keeping up with the debt that they're accumulating as well. So, here I'm trying to look for signs of an impending recession, and I'm still not seeing them. I think we're still in good shape at the moment. And then, of course, we do have the CPI numbers. That finally, the last few months, has also ticked down. So we're at 2.4%. This is just a different measure, a different gauge of inflation that the Federal Reserve will look at. And the September number, of course, is the last number we have. We won't be getting the next number from October. I think it's coming next week. Is that right, Thomas? Or is it later this week?
For the next CPI?
Yes.
Yeah, I am not sure when. Then it should be soon.
Yeah, it'll be coming soon. So we'll be looking for that number to see if it continues to go down as well. But again, all items are going in the right direction. When we take out food and energy, we see it's at 3.3%. There's a little bit of an uptick back in September, but we'll see if that continues its downward trend as well. So lots of good news here. And what we're seeing from the sentiment survey itself is that inflation concerns are easing. So a positive number here is not good because of the way we word the question. And the question is, I'm extremely concerned about the impact inflation will have on my firm in the coming year. So that positive number going down is good news. And one thing you have to keep in mind is that the Q4 number here for this year actually came in September before the Federal Reserve started cutting rates, before we had some good job numbers after somewhat of a weak July and August. So I fully expect that when we have our Q1 survey in January, I think this number will continue to trend down even more. I think inflation concerns are really easing, but there are some areas that I know you're still concerned about, Thomas.
Yeah, so this is something similar we've looked at in the past, but really how much total prices have changed. And so whether we're accounting for the volatility of food and energy or not, excluding it, prices are still up about 25 to 23% since January 2021. The rate of change has slowed a little bit, but it's still, things are still very expensive. And I think if we go to the next slide, what we see is essentially, this golden line is the cost of services, and that just continues to go up, right? And so the black line, which is the cost of goods, things that are made, basically was pretty reactionary to when the Fed started raising interest rates in the spring of 2022. You could see that black line has essentially just stayed flat over the past 2.5 years, while the cost of services continues to rise. And, that's about 70% of household spending is services. So I think that is concerning and is something to continue to keep an eye on.
And Thomas, why is it that services are still increasing in terms of the cost?
I think it goes back to the employment costs and wages and, a little bit, there's this big shock that occurred in 2020. And then we'll see in some other slides, 2021 through 2023 was basically this reaction boomerang to a shock that happened. And then there was a bit of stabilizing from 2023, the beginning of 2023 onward. But, going back to your chart around labor force participation, we're still at 4.1% unemployment, which is very, very, very low historically, that there's a bit of an imbalance. And so, I think the most recent employment cost index showed 3.9% year over year growth, right? So a year and a half ago, I think that number was closer to 6%, but this year it was 4%. So, what it costs an employer to have an employee continues to increase.
Yeah, I think that's my read on it as well. And we're just in this cycle where we don't have enough people, so that is putting upward pressure on wages and therefore going to, passing through to the cost of services. Talk about the PPI numbers. What are you seeing there, Thomas?
Right. So, it's a similar story that I just said on the left. This is total construction costs for non-residential construction. And essentially, you know, from the beginning of 2021 to the beginning of 2023, we had that very steep increase, but essentially since January of 2023, non-residential construction is basically down 0.5%, right? And that includes all the labor, design, as well as all the materials. And most of that, you know, exponential growth that happened in the 2 years post-pandemic, we're on the material side, and that's all, for lack of a better term, under control. For the AE services, which is essentially the cost of, you know, our member firms' services, that, you know, continues to slowly go up and to the right. And I believe over the same time period where, you know, total construction costs really are flat, they've grown 3.4, you know, since the beginning of 2023, AE services has risen 3.4%. So that is continuing, you know, to go up.
Yeah, and one of the things we're seeing from our data that we collect in the sentiment survey over the last couple of years is that firms are telling us their wages have gone up 9-10% year over year over year, you know, for 3 years in a row now. We're going to be asking that question again in Q1, so stay tuned and see if maybe the pressures have eased just a little bit or not in the first quarter survey. But my sense is that firms are still struggling to keep up with the wage demands here from the workers.
Absolutely.
Yeah, I was also on a panel last Friday, and I was talking with one of our member firms, and you know, the numbers that you're seeing for wage increases from the Bureau of Labor Statistics are, as you said, around 4%, 4.5%. But you know, this firm leader was saying, no, we're seeing much higher increases than that. So I think there is maybe a little bit of disconnect between some of the Bureau of Labor Statistics numbers and what a lot of firms are seeing in their own firms. So with the interest rates being cut by the Federal Reserve, we're down, you know, 0.75 points now, and we'll see what happens tomorrow. You would expect that interest rates for household consumer goods or housing and things of that nature would decline as well. And we did see that in the first, you know, from sort of earlier this year, where we were above 7% for 30-year fixed mortgage rates, which is what I like to look at just as a benchmark, because that's what most people have for their house when they get a loan. It was going down, and we were at almost back down to about 6% until September, when it started to shoot back up. I think, you know, there might be a few different reasons for this, and I'm interested in your thoughts on it as well, Thomas. But I think people were anticipating that post-election, regardless of who won, that we might start seeing more inflationary pressures from the policy side of things, and that might push up the 10-year Treasury note, which is, in fact, what sort of moves mortgage rates. And so this is pretty dramatic, though. You know, in just 2 months, we've seen those mortgage rates go up a whole percentage point. So that's a little bit concerning to me, Thomas. What's your take on that?
Yeah, no, I mean, I think it's not good that because of, I guess, the uncertainty concern the financial markets have with these in the bond market, it essentially is like counteracting the Fed's, you know, attempts to, let's say, ease credit, and, you know, can basically put us in a kind of sticky position of almost like, you know, I think you might have said it somewhat recently, a thing of stagflation, where, you know, there might be growth, but there's still also inflation. Credit is expensive, even if the Fed funds rate is getting lowered. So I think it's, you know, hopefully maybe over the next 3 to 6 months, there might be better certainty or, you know, less concern. I think some of it too is tied to federal debt and, you know, folks' concerns about that as well, and the deficit.
Yeah, I've been hearing a lot of chatter about that as well, that the debt load is, obviously it's more than 100% of GDP at this point. So it's really quite a significant concern. All right, well, that's how the economy is doing. Still mostly good signs that we're seeing. Still, shortage of labor, and that's resulting in wage pressures going up, which could impact inflation as well. And it is obviously impacting the services side of the inflation equation. So that's something that we're going to continue to watch. Well, how is our industry doing? Thomas, what are your latest numbers?
Yeah, so I mean, in terms of nominal total revenue, the industry continues to, grow, while the most recent quarter-over-quarter growth is only 1.7%. Revenues were still up 8.1% year over year. This is through the first half of 2024, and that is kind of good. It's moderating, right, compared to maybe a year and a half, when we'll see on the next chart, we were seeing, almost double-digit year-over-year growth, but in terms of industry revenues, it's continuing to move along, and it's growing. So that's really, solid for the industry. And when we look at here on the left-hand side is the year-over-year growth, coupled with the year-over-year change in employment. What we see is, there had been more volatility with respect to total top line revenue, but what's good is the employment is pretty solid, and even since towards the end of 2023, when maybe there were thoughts about things slowing down, employment growth is still around like 2.3%. So the revenue is growing more than the amount of people they're hiring. So there's obviously some sort of capacity or constraints situation playing out. But I think, these, charts are showing that, we're continuing to move strongly, and, it's not any immediate concern, given maybe slowing or other, tightening factors elsewhere.
Right. Yeah, it seems like if we just had more workers, then we wouldn't have any real concerns at the moment. But that certainly is a concern. So turning back to the sentiment data, we use a net rating, which I should have explained on the previous slide, but the net rating is simply we take the percentage of positive responses and we subtract the percentage of negative responses. Those who are neutral, we ignore, because what we're trying to see is, on balance, are firm leaders feeling more positive or less positive. The idea being, if you have more leaders at firms feeling positive than not positive, that you're going to continue to see expansion within our industry. So we have three ratings that we monitor. One is the condition of the U.S. economy. The second is the condition of the engineering and design services industry. And the third is the condition of your firm's overall finances. We have seen very solid numbers now with the condition of the U.S. economy. It's moderating just a little bit, a point or three here over the last couple quarters, but the low point was in 2022 in the third quarter, so just a little more than 2 years ago, and it was a -15. So most firm leaders are feeling much more positive than they were, certainly compared to 2 years ago. And this survey is based on about 600 firm leaders who are ACEC members. So we're seeing very positive results here in the economy, and we continue to see exceptionally high numbers for the industry as well as firm finances. We can't have a rating over 100, because if everyone was feeling positive, we would have 100. If everyone felt negative, we'd have a -100. So 83, 85, you really can't do much better than that. So that's continued good news in terms of sentiment regarding our industry. And I showed this slide because I want you all to know that in the full report, which is available to everybody for free, we have a QR code at the end of the presentation I'll show you. This is some of the detail that you can get from the full report. It gives you detail in terms of the regional numbers as well as the firm size. And this is specifically the condition of the U.S. economy. We show quarter over quarter changes as well as changes versus the previous year. You can see that most of the cuts here in the data are still positive compared to last year, although there's been a few that have declined quarter over quarter. The other thing you'll notice is that smaller firms, those with 1 to 25 FTE, tend to be less positive on almost all metrics. They're still positive, but they tend to be less positive than, say, the largest firms. And that's a trend we've seen for the last 3 years since we started conducting this survey. We also look at sentiment by industry sector. You can see the blue circles are the sectors with the highest sentiment. So data centers, water and wastewater, transportation in terms of roads and bridges, as well as airports. We also have energy and utilities. These, of course, are all areas, with the exception of data centers, that are being propped up by IIJA. You can see that the quarterly changes, again, there's some that have gone up, some that have gone down. The year over year, which is how we've sorted this list, you see about more than half have declined compared to last year, but a lot of those are by 1 point or 2 points. So there hasn't been a lot of change in the industry segments. Commercial is definitely down a bit, and that's, I think, to be expected, given that we have a lot of commercial real estate that the leases are coming up for renewal, and as people have downsized their footprint on their leases from the pandemic, we're seeing a lot more space available, particularly in some of the big major markets out in the West. We're seeing pretty high vacancy rates. So commercial sector is definitely the least positive in terms of all of the sectors we have. Thomas, you track this data in a slightly different view. What's your data showing you?
Yeah, I mean, the say sectors that are growing and have some amount of significance: manufacturing, water, power, continue to grow. Manufacturing, which this time last year was growing at about like 80 to 90% year over year, is now only 23% year over year, and that's probably going to continue to decline just because of how massive it grew over the past 18 months. But power, this kind of general energy transition theme that has existed for a while, is probably going to continue to stay pretty large and be robust. Manufacturing is more affected by federal policy with respect to these sectors that are not growing, right? Commercial, obviously, which we talked about. Then office, is barely positive, and that's mainly because data centers are included in that overall category. If you were to exclude data centers, office construction would essentially be negative as well. These are two industries that are very much tied to interest rate levels, and I think folks in the commercial space were not too concerned 6 months ago, but now we're going on like a solid year of declines. And with where interest rates are and these other trends, I think continuing to keep an eye on the commercial space is going to be important over the next 6 months.
Yeah, in this presentation I saw on Friday by an economist, he also was showing a lot of really interesting data about the debt sort of for commercial real estate is starting to turn over, and
Right.
that is going to be a significant drag because interest rates are higher than they were 4 years ago. So
Yeah,
that's
exactly.
another, yeah. So I think there's real concern in that sector, and we're just going to have to keep watching it and see what happens. One of the other metrics we track with the sentiment study is backlog. Here, the numbers are also very good. This is the median backlog among all firms that are reporting. We have lower backlog among smaller firms, usually the 1 to 25 FTE. The backlog tends to be a median of 6 months, whereas firms that are 500 FTE and more, they tend to have backlogs of more like 18 months or higher. So we're seeing very strong and consistent backlog numbers. So there's really no red flags or even yellow flags here. When we look at the labor situation among our member firms, we continue to see indications of a very tight labor market. At least 9 out of 10 firms have open positions. That's actually increased just a little bit in the last year from 87% to 92% of firms, but we've been trending for the last 3 years that we've conducted this study. It's always been about 9 out of 10 firms have open positions, and the median number stands at 5. Now that's again among all firms. So small firms tend to have fewer positions, of course, open. Larger firms tend to have a lot more positions open. So what we do to try to make sense of it is look at the open positions as a percentage of FTEs at the firm. And so we look at that by region. They're pretty consistent across the regions, which would make sense. Firm size, that's where you see the differences. And really that 1 to 25 firm size, it's percentagely higher simply because if you have 10-person firm and you have 2 openings, well, that's 20%. But generally speaking, the overall percentage is at 8. Now that is a slight decline over the prior quarter and previous quarters. It had been very, very steady at 9%. We've seen this drop now to 8%. We'll have to see if that holds, but that is a sign that perhaps we're starting to see a little bit of easing in the labor markets. And some of the other data that we'll share with you supports that notion as well, that maybe, just maybe, we're seeing a little bit of easing, but it's still extremely tight. All right, well, let's turn our attention to the future here and see what we're looking at going forward. So this here is our most recent forecast that was just released at the fall conference. And in 2 weeks, or well, oops, sorry about that. We're also going to have a separate webcast coming up in the next week or two that's going to focus just on the updated economic assessment and forecast. But I want to give you a preview of what we're looking at here. And so this is actually from the last, I'm sorry, this is the last time we did this study. We're going to show you the updated numbers in a week or so. But nonetheless, we're looking at, a strong forecast in terms of positive growth over the next few years. So stay tuned for the updated study results in the next webinar.
Hey, Joe, just a quick question back to the open positions before you move on. Sure. So we're getting a question about that drop you mentioned from the 9% to the 8%. Is that a result of filling positions or less job openings? I mean, so they're sort of one and the same, but are people? Yeah. I think the bigger question is: are people scaling back on the number of positions, or they're filling all of the ones they have open?
So I think it's a little bit of both. What we're seeing is that the largest firms have fewer open positions now. So they have definitely filled positions, but we think from other data that we're seeing in the survey that they're also starting to slow down in terms of the number of new open positions that they're seeing. So it's a little bit of both, but overall, in the end, we are just seeing fewer open positions among those largest firms. Now, there's still a very large number of open positions, but that's where we're seeing the numbers move a little bit.
Great. And if you could just go back to the forecast chart, I have one question related to that. They're asking about the chart at the bottom, the difference between nominal and real output, if you could explain that.
Yes, of course. So what we're seeing here is nominal output growth. That is not including inflation. So that's just top line numbers in dollars year over year. And so that's why that percentage is higher. When you talk about real output growth, that's taking into consideration the impact that inflation has had. And so that growth is lower than what you're seeing from a nominal point of view. So that's the delta there between the two. And as you can see over the coming years, we're expecting inflation to subside as it has, and that's why the delta is a little bit less than what you would see, for instance, in 2023.
Thanks, Joe.
Sure. Okay, so now we're looking forward. We're looking 12 months ahead, and this is the sentiment from firm leaders looking 12 months ahead. Is it going to get better, worse, or stay the same? And so a positive number would indicate it would be better. But what's really interesting to me here is that we saw pretty significant declines in Q4 over Q3. Now, again, we have to remember the timing of this particular survey in Q4 was in early September. And that could be a reason why we saw some of these declines from the third quarter. We will just have to wait and see. But it could also indicate that firms are anticipating a more moderate pace of growth in the coming year than perhaps what we've seen in the last few years. And that certainly is shown in the forecast data that I just showed you. And again, we'll have the updated numbers for you at the next webinar. So we'll need to see what happens in Q1 with this particular chart. Do we see a little bit of a bounce back? Do these numbers hold steady with Q4, or do they go down even further, indicating that firms are definitely anticipating moderating growth? So that's the big question, I think, that we have from this quarter to next quarter. And when you look at the overall economy 12 months from now, again, we see that almost all of those cuts of the data, regional as well as firm size, they've declined from the previous quarter. Now, we're still much better than we were last year at this time, but are we seeing a softening of expectations? I think that's the big question here. Thomas, do you have any insight? When you talk with firm leaders, are they talking about this at all, or is this something that you're not quite sure about as well?
Yeah, I mean, I think to go back, if we look at people's responses a year ago, or in that 2023 Q4 quarter, according to that, the economy would be very bad. Right? We've just been wrong. The past 18 months is basically it, and kind of going back to what I was articulating, this pandemic shock, I think, is like a very, very big shock. And, it took 2+ years after the shock to have these kind of reverberations. And so we some of it is probably maybe people's gut feels, and some of it is, hard to really tell because so many different pieces are moving differently in the economy. And just looking at, say, some of the sectors, some sectors are continuing to grow very well and have very good outlooks, and other sectors are not. And so I think it's probably this hodgepodge of all of it kind of coming together and being aggregated.
Yeah, and you make a really, really good point. We have gotten questions in the past about this future-looking metric, and has it been accurate? And it hasn't been accurate. We just are not being very good at predicting the future. And what we tend to see is that this metric correlates more with current optimism or pessimism than it actually does with what happens a year from now. So you're right. You look a year back, and all those numbers would indicate we would be doing worse right now than we are, and that just hasn't materialized. So I think in general, humans tend to be a little bit risk averse, a little bit more less optimistic about the future, but I really like your point about this post-pandemic environment, that it's sort of taking a while to perhaps shake off the concerns that we might have about our future.
Mm-hmm.
And Joe, just for clarification, your point about, not being great at predicting the future was related to the sentiment study, not the forecast that you had just shown. So I know you've shown a bunch of data here, and I just want to make sure there's clarity around that.
Yes, that's a very good point, because the forecast in terms of the growth for the industry, we've actually been pretty good and pretty on target with that. It's the sentiment, it's people's concern and feeling about the future that tends to not be accurate at this point. So when we look at the sector performance, again, in the future, we still see with these blue circles, the areas that are doing well now, folks tend to feel those will be doing the best a year from now. Pretty much all the same areas. Areas that perhaps may not do as well, we've talked about commercial real estate. That's improved over the last year, but it's still low compared to others. Convention centers, it also has improved slightly over the last year, but it's negative. Justice is at 0, so that's even. So we're seeing a lot of areas here that have improved in terms of their sentiment forward looking compared to a year ago, and particularly residential land development. And I think that's one area where folks have been trending in this positive direction, and things are looking better in the residential land development area. Excuse me. All right, so we ask for firm leaders and firm executives, if they have a negative outlook, why is that? And again, remember, this was early September, so this was before the election occurred as well. And we see general economic uncertainty being the #1 issue of concern, political uncertainty being #2. We'll see what that looks like in January. But it'll be interesting, because in January, the timing of our survey will be early January, before Inauguration Day. So it'll be interesting to see if this political uncertainty is still high, or if it has dropped at that point, if there's more clarity in terms of the direction that we'll be heading. Inflation and rising costs, that's #3. And recession concerns is #4. So we still have some concern out there regarding recession. Workforce shortage has declined quite a bit. So that is a good number. It's still high, but it's coming down. And interest rate increases, that has gone from 72% last year at this time to 31%. So that's come way, way down as well. So speaking of inflation, Thomas.
Yeah, so this is looking at the global supply chain pressure index, and this is really going to affect costs of goods, right? And when the orange line is basically above 0, essentially moving goods around the world either takes more time or is more, which essentially then makes it more costly, right? Because the cost of shipping is going to increase, or there are going to be delays, which can impact all of that. And so, we had this huge shock during the pandemic, and then we had a swing, where there's a lot of free flow. And now we're kind of right about at, free, to use the term for traveling on a highway, free flow speed. So it's right at the speed limit. But I mean, I think the fact that most of the easing in inflation has been on the goods side and not services, as we've seen before, means this is definitely something to continue to monitor, because if we start seeing pressures here with respect to global supply chains, that's going to very quickly impact the goods side, which is going to make inflation painful again. And so it's just something to keep an eye on.
Well, when we look at our future backlog sentiment from the sentiment survey, we also see that moderating just a little bit over the last year, but still very, very positive. So no real concerns here. And then when you look at that detail, you can see that smaller firms have lower, a little less positive than those larger firms when it comes to backlog 12 months from now. But we do see that these future backlog intentions have declined among most firm sizes over the last year. And in fact, the largest declines are among the larger firms. So it looks here like large firms are saying, well, we're anticipating perhaps a little bit less positivity in terms of backlog than perhaps we thought maybe a year ago. But again, when we look at our actual backlog numbers, they've been very steady and very stable. So this is just some pessimism creeping in, I think. When we look at the status of hiring, this is where I think it gets really interesting, because this is looking ahead 12 months from now. Do you think the number of FTEs at your organization will increase, decrease, or stay the same? So we still see on balance that firms are saying we're going to have more workers a year from now, but those numbers are softening just a little bit. And so this says to me that we're seeing fewer positions perhaps that will become available, and that's going to help ease a little bit the demand side of the equation for labor. And you see that among almost all firm sizes here. So again, it's still very strong, very, very strongly positive, especially among those larger firms, but it is starting to come down just a little bit among most firm sizes. We've asked this question periodically over the last couple of years. Has your firm turned down work due to shortage in workforce, in labor? And this could be that you've turned it down, or that you just have opted not to go after it. You haven't pursued that work when it's available. But regardless of how you want to word it, half of firms are saying that, yeah, we've turned down work. We just don't have enough folks to do the work, and so we've turned it down. And that number has been pretty consistent. And when we ask what type of work firms are turning down, they're saying, well, we are being more selective, so 80% of these firms are saying we're being more selective about what we're accepting and what we're going after. So that's not bad necessarily. We're turning down less profitable work. That also is not a bad thing for your business. But I always like to look at the percentage of firms that are turning down good, profitable projects, because that, again, is if you have the workers, you would want that work. And a quarter of firms who've turned down work say it's because they don't have enough people, and that number keeps growing just slightly over the last couple of years. So that really shows us that if we had more people available to do the work, we could grow revenues even further. And then this is my last
Hey,
slide.
Joe, just before you move
Yeah,
off of that,
sure.
someone's asking, does that mean they're giving up, accepted the reality of not, I'm trying to understand the question, or does that mean firms are giving up, accepted the reality of not likely to add staff that they would like?
Well, that's a good question. Our data doesn't tell me the answer to that. So I'm not sure. That would be an interesting question to ask in the next survey. But no, we don't know whether that's because firms are saying, we're just accepting the reality that we can't get as many workers as we want, so we're not going to try.
Right.
Yeah, I don't know. Thomas, do you have any thoughts on that one?
I mean, I think it's thinking of the chart showing the growth in the number of employees. They are adding employees, but the amount of employees they can add is right. There's that capacity issue. But in your slide about how many open positions there are, those numbers are pretty constant over time. Maybe they've changed by a percentage point. So it tells me like a firm is still trying to, is basically 10% under capacity, whether or not they've just accepted they won't ever be at full capacity or not. I don't think you could really tease that out.
So I'll make a note, Joan. We'll see about adding that next time.
Okay, yeah, it's a good question. I love questions from the audience because a lot of times that gives me ideas for things we can ask in future surveys. So that's a very good question. We do ask now on a quarterly basis what the perception of the likelihood of a recession is in the next 6 months. This has not gone above 50%. So on balance, we the firm leaders feel that it's less likely than more likely, but it's up 3 points from last quarter. So this is a metric that we will continue to watch. And some other metrics I've seen from other surveys have this number even lower than what our firm leaders are putting it at. I've seen 33, 35% recently among a sort of broader surveys than just our industry. So right now, firm leaders are not anticipating a recession in the next 6 months, and probably not even in the next year. Thomas, what's your view on the likelihood of a recession next year?
Yeah, I see maybe at the very end of 2025 there could be negative, GDP growth, but I think the bigger issue I would be worried about is inflation and costs and what's going on with interest rates. Because if we hit a situation where inflation starts to go up again, yet we haven't really brought down interest rates, then, things like a 7% mortgage are going to seem good if, it's now 10%. And I think that's a bigger concern than necessarily GDP going negative over the next, 12 months.
Yeah, and I think there's also a lot of unknowns in terms of what are the policies that the new administration will enact and how is that going to affect the economy. If we're talking about, as has been in the press, mass deportations, we already have a labor shortage at all levels of the economy. So if you are starting to take individuals who are working and you put them out of the country, then that just puts more pressure on labor as well. If you're talking about tariffs, well, that's a tax essentially on the consumer because that's passed through. That's going to negatively affect GDP as well. So there are some questions. I think it's just too early to tell what's really going to happen next year. And so I think we have to stay tuned and see what happens. So looking at what's next, again, we have consumer spending that's holding up very strong. Consumers don't seem to be running out of steam quite yet. We do have labor pressures, of course, a lack of enough workers. Inflation concerns are definitely easing, and the Fed is cutting rates. So we'll see if that continues or if we start to see higher inflationary numbers. Are they going to reverse course or stop cutting rates? I think that's a big question coming into 2025. Housing market's doing quite well overall. The prices have stabilized. They're not going up by double digits or anything close to that. So that's good news. But the level of inventory is at an all-time, generational low. So it's very, very hard to find houses to buy, and that is keeping prices propped up. And as we talked about, interest rates have shot up a bit the last few months. So the bottom line, though, is that there just isn't enough housing to satisfy demand. And there's a lot of pent-up demand from what I've seen, Thomas. And I think that if interest rates do come down, or perhaps people just say, you know what, they're not going to come down, so I'm going to go ahead and get in the market if I can. But I think home builders are also responding, and they're indicating that they're going to be building more homes as well. Recession concerns are not a concern at the moment. We'll see what happens into next year, but everything is looking just fine for now. All right, well, that's all we have for you today. I do want to thank all of our sponsors. The ACEC Research Institute simply could not do the work that we do without your support. We have many MOs who are supporting our work, and as you can see, a lot of firms are supporting the ACEC Research Institute. So thank you to all of you who are helping to make this work possible. We'd also like you to download the business sentiment report for Q4. Here's the QR code for that. I'll leave it there for just a moment, and I'll go on to the next slide, which has the registration QR code for the forecast, which will be on November 21st at 12:30. Meanwhile, Daphne, I think you might have some closing comments.
Thanks, Joe. Thomas, Joe, thank you so much for all of your insights, great data, lots of good information to share. As Joe mentioned, the sentiment study, the full report has a lot more details in it than we are able to cover certainly in this hour. So please download that. Join us next Thursday. Here is the registration for the session where we will dive into the economic assessment and the 5-year forecast, and we will have our economist John Gray on the line for that, along with Joe, and give you a lot more details than certainly we covered today. Thank you to all of our donors. As Joe said, we could not do this without you, and thank you to each of you for joining us today. We will be sending you a survey. We appreciate your feedback. Have a great day.